Hello and welcome to this October 4th, 2010 video version of Invested Central's Chart of the Day. I'm Tom Boley, Invested Central's Chief Market Strategist, and it's my pleasure to provide you today's Chart of the Day. This Chart of the Day is brought to you by StockCharts.com, simply the web's best financial charts. Today we're taking a look at the Volatility Index, or the VIX. Many in the market refer to this as the Fear Index or the Fear Gauge. And generally the reason it gets that name is because when the markets are heading lower, the VIX generally heads higher. The Volatility Index is based on the pricing of certain S&P contracts, option contracts, and attempts really to look at the expected volatility or the implied volatility over the next 30 days. So normally as a market is falling and additional fear is created in the market, it creates more of a panic, and as a result options are priced higher, and that sends the VIX higher. The opposite generally holds true when the market is moving higher. When the market moves higher, there's not generally as much panic to get involved in a market that's going higher when you look at that on a relative basis to the fear that's in the market to get out when the market's going lower. That's why, even though the volatility may be the same in terms of upward movement in the stock market versus the downward movement, it doesn't generally have the same impact on the VIX. And if you go back and look over time, you'll find that to be the case. Anytime the market itself tends to move higher, you generally see the VIX coming down, and when the market is moving lower, the VIX is moving up. So when you take a look at this chart here on the VIX, and what I have at the bottom here is the Volatility Index, and at the top I have the S&P 500. Both are line charts, so they're just showing you the closes. It's just, these lines are just connecting the close each day through a period. So we have about a 5-month period where we've got the information, or actually 6-month period, where we've got the daily closes for both the Volatility Index and for the S&P 500. And then we've just got about a 45-day window here that's open on the right-hand side. But take a look at what happens. I mean, when you look at the mirror image, on the way down from April all the way through May, you can see on this first move down that the VIX went straight up. And that's because panic was setting in. We had the flash crash. Everybody was panicked. They thought we were in for another crash similar to what happened in October in 2008. And quickly, the fear levels raised among traders, and you can see it in the VIX. The VIX went up to 45 from down around 16 and did it in about 3 weeks during this move to the downside. Now, once things start to settle down, you will come down off of elevated levels off the VIX, and we saw that even though the S&P 500 kept moving lower back in July, the VIX was coming down. And you might even look at that and say, well, maybe that was a little bit of a warning sign to the bears that it was time to get out, because even though the market was going lower, the panic was not going higher. The panic actually was starting to come back down, and sure enough, the market did stabilize back in early July and went sideways for a while, and then recently broke out. But this is one of the problems we have with the market right now, is now you've got the S&P 500, and this is the S&P 500 up here. The S&P 500 was rising throughout September. And if you look, almost every other period where we've seen rising prices, you'll see a VIX that's downtrending. Yet with this September rise in prices, notice that the VIX is just sideways consolidating. It's really not dropping like you would expect during an uptrending market. So is it the case where the VIX is now going to start to catch up and fall to the downside, or is the VIX kind of giving us a sign that the market is still expecting volatility down the road, which would generally coincide with market weakness? And I think that's a big question as we go forward, and one of the reasons why we maintain a very, very cautious stance in the market. We're not bearish, but we're very cautious, looking for any additional signs that would suggest maybe a short-term top is in. I hope you've enjoyed our presentation today. Be sure to check out our chart of the day every day at investedcentral.com. While you're there, sign up for our free weekly Market Pulse newsletter and have the chart of the day emailed directly to you. Happy trading.